Good afternoon. Welcome to another edition of Macro Views at Grinnell Capital. My name is Frank Grinnell, portfolio manager and co-founder. Welcome to the financial advisors and the independent investors out there. Hopefully you learned something today. We have a decent amount of content. We're going to try to get through things in a relatively efficient manner, but hopefully add some value to what you're doing out there. I'm going to share a screen. And boom, there we are. Okay, we're going to take a look at the technology playbook for 2022. The reason I'm kind of half smiling is if you've been paying attention to the markets, that's no easy feat. Even today, let's just take a quick second to talk about the action today. We had a hugely hot CPI print this morning, right? Consumer Price Index coming in at up 7.5 year over year versus 7.2 expected. Real hot. Gap down on futures on that, which to be expected, and the market kind of took it in stride, right? Traded higher throughout the morning until the 10-year eclipsed 2% at a pretty decent clip, and then things retreated from there, and that's where we are right now. So I think the glass half full message is that the market is starting to digest the direction we have to head. It just doesn't like things to happen all that fast when it comes to rate rises. But let's dig into the webinar. Okay, 2022 may be a very important accumulation year for tech. The word accumulation there is not by accident. So what that means is you might not have the best performance from all your technology names for 2022. I actually think there are going to be really good performers for 22. But I think the whole point is you're getting an opportunity to buy a lot of these amazing growth stocks at discounts that you may not see for the next 2, 3, 5 years down the road. That's the point. But I think you need to be very purposeful, and we're going to talk about that. So what is the playbook? And we've got one, and we'll kind of share with you what ours is, and hopefully you construct your own playbook for this year. So the current situation, as you guys are well aware, we've got inflation that is on the present for the Federal Reserve. It's on the present for me, and it probably is for you as well. The house view, Grinnell Capital, is this thing does probably tame itself down as we get into the summertime. I do think growth's going to slow, and with that, I think inflation's going to be tempered a bit, but I do think it's going to be higher than it was 2 years ago for a longer period of time, right? Next big thing along with inflation, we've got rising interest rates. We just talked about that as the 10-year eclipsed over 2% at a pretty good clip this morning, kind of spooked the equity market. Bids went away, stocks went down. I don't think it's run for the hill type thing in January again. I think we've had that pretty good reset. That being said, I still think you got to be real careful when it comes to asset allocation and what you're doing with your money. And then potentially slowing growth. I don't think I'm not going out on a limb here. Coming off COVID, we had those huge GDP numbers, 5% growth. I think that's gone. I think we'll get back closer to that, sort of two and change number that we've seen forever. Hopefully it'll be more like a 3 and change number. I think it can be. I think the strength of the consumer is there 100%. I think enterprise is in real good shape. So hopefully that 3 handle can continue off for a certain period of time. But, what about, technology? You guys all probably have your interest rate sensitive stocks. You've got your value stocks. You own the banks, you own commodities, all that good stuff like you're supposed to in a rising rate environment. But what about tech? You think back to 2020, that was a real fun year, right? Tech went raging. ARC Innovation did so well. What would Kathy Woods is up like 150%. But, this is 2022. There's the broken, uptrend. That's probably what January looked like. So it's not gloom and doom by any means, but I don't have to tell you guys, this is a different environment. We got a kind of a warm up for it in 21 as really just, 5 or 6 macro cap tech names led the entire market. And breadth underneath the surface was pretty terrible. That's actually changing this year. I'm not going to get into that. It's a little off topic. But as we get into 2022, we know this Fed shrinking their balance sheet. This is a relatively new thing, right? Since 2009, the Federal Reserve has been relatively expansionary in terms of their balance sheet and accommodative. So this is definitely a new thing, and so far so good, honestly. I think for the market and how it's taking things. I put raising a rate 10 times this year. That's a joke. Hopefully that doesn't happen. But the market, I think, has already discounted probably 6 rate hikes in for this year. And there's a real good possibility, I think, after today's print, we'll see what further data brings, but March might see a 50 basis point move. And I'm not sure it'd be a huge shock. I'm not sure it would be this, terrible thing. I think the market is prepared for these things. And, ARK stocks have been crushed. So again, this is 22. ARK can probably have a rebound, but it's a different time. It's a different time. And I think purposeful investing has got its place all over again. So how are you supposed to invest in tech in this current environment? Taking a look. And, which is great about this current time frame is we've got a body of work to take a look at. You've got Q4 earnings reports coming in on the tape every morning, every afternoon, right? So we're getting a real-time look and a view on companies, how they're doing when it comes to their results, top line, bottom line, inflation, supply chain, all that stuff. We're getting a real-time update on. And honestly, like a lot of these companies look great. There's, the PayPals and the Facebooks and Metas of the world, which, not so wonderful. But we look at some stocks that have had solid execution. And importantly, and I don't just mean how they report, again, on the bottom top line and what have you, commentary going forward about the outlook. How do the stocks act, right? So important. How do the stocks act on that print the next day, the day after? You get that gap up. All these names that I'm going to put up on this, have passed that test on that Q4 earnings, and it had a good stock gap up the next day. Some of them huge moves, 10%, 15, 20%. But if you go back and retrace all of these, very few of them have gone up and away to the right? You get the gap up. A lot of them trade even lower on that day, and even more of them kind of bleed a little bit lower in the following days. I think some of these, Google, Microsoft, less so for the smaller cap names that you see on there, like a Unity or a Bill.com, are crowded. I think a lot of them are crowded names. Amazon, great numbers. But a lot of these are crowded, and I think you are seeing that kind of reversion. Some people taking chips off the table still. So for me, in this list, and we'll talk about this again in a second, these are the guys that have passed the test as far as the current quarter, what they've put up, how their stocks have acted. These aren't all necessarily the ones you go out and buy a full position in tomorrow, right? That's coming up. So yeah, not ready to go all in. I'm not ready to go all in on all the names, that's for sure. We want to be real careful about this. Valuation is still a concern out there. We've come down a ton, but you still have some names like a Snowflake that trades at 70 times forward sales. Fastest growing company probably on the planet. So it should trade at a huge premium, but is that premium too much still? Fed hasn't even raised rates yet, right? We haven't even started this process. March will be the first time they go. You got guys like Dan Niles, more handsome and smarter than I am, talking about he thinks the S&P is going to be down 20% to the start of this year. So he's looking for a 20% correction in the S&P. And you got guys like Jeremy Grantham, another famous investor, a little older and more wise than I am. But he's thinking that we get a 45% decline. I think Jeremy's a little off base. I think the earnings power is a little too strong for such a move. But nevertheless, you've got these kind of headwinds out there, right? So tier one, you're going to see that this is the first list of stocks that I think makes sense. Our criteria isn't necessarily rocket science. Strong balance sheet, positive cash flow, positive free cash flow, low or no debt, low leverage, reasonable PE. So the fact that they actually have a PE, I think, is important. That's just what the current environment dictates. I think for ones that you can sleep good at night. So what do those names look like? And this is our okay to buy. We feel like you can have a full position if that's a 3% weighting, if that's a 4% weighting. I think that makes sense. And these aren't, Microsoft. A lot on the come when it comes to gaming. The Activision purchase, I think, is going to be huge for these guys. Google, I love the on the come for those guys is reopening of the economy, phase 3, right? Travel and leisure. They're a huge beneficiary when it comes to advertising and search and travel and leisure. So many people go to Google to research where they're going to go, what they're going to do, concerts they're going to see, you name it. Apple, another one, you own it, you don't trade it. AMD, Lisa Su, one of the most visionary, amazing CEOs of our time. AMD is going to be getting into a bunch of different verticals when it comes to semiconductors. I don't think you want to bail on her. I put Ericsson up here and I put metrics on there because you guys probably, I haven't paid a ton of close attention to Ericsson recently. Remember how cool their brick handset was back in 1997. But these guys are obviously into the 5G infrastructure. Recent quarter, They reported a great number. And actually, that's one of the few charts you pick it, pull it up, you'll see stock gap up and actually traded up and away from there to the point where I think it has to consolidate a little bit now. But it's cheap, right? It's 14.8 times 2022 earnings, 1.5 times sales. That is cheap. Discount to the S&P, growing faster. It's European, so it's out of the US for what that's worth. And the commentary from them on their call was, given how well things are going in 5G infrastructure, they actually see a bigger tailwind. They're looking for more promising results on the top and bottom line from their enterprise business, which they look to be picking up later this year into 23. So kind of a pass the baton, if you will, from the infrastructure business into the enterprise business. Looks really solid for the near, medium, long term. And Qualcomm, I put this one up too. Qualcomm trading at 15 times 22 EPS, not a commanding multiple whatsoever. These guys are hitting on all cylinders. You pull up the recent quarter, awesome quarter. Stocks get knocked around a bit. I wouldn't think much of it. I accumulate that on down days. Love Qualcomm from here. And Corning. So some would have you say, I haven't done a ton of work here, so I can't be the authority on this. But I've listened to analysts who believe that we are at the start of a 2-year optical cycle where Corning would be a huge beneficiary. Great earnings report, not an expensive stock. I think a real kind of low risk potential reward scenario for Corning as well. Moving on, one of the biggest concerns in the current environment is wage inflation. So I've got a nice little sign graph there of economic cycle. But Tobias Levkovich is a gentleman you may or may not have heard of. He was, unfortunately, he passed away from an accident this past year. Chief equity strategist over at Citi for a number of years. Awesome guy, great calls. And he would remind us, at the time I was institutional sales, and he would, tell us like, hey, it really is that wage inflation, that increase in wage growth that you see that ends up tipping the scales in an economic cycle. It's kind of that, it makes all the sense in the world, right? When companies are doing so well, product sales are great, profitability is great, we'll pay our employees more, perfect, boom. That's kind of the one last little thing that hits margins a bit before sales contract. I don't think that's the case I'm not necessarily making that call on the broad economy, but as well as I do, there is definitely wage inflation out there. People are getting paid more than they have in the past for pretty much any position. Now, the good news for tech, this is not unfamiliar territory for technology. You've always had to pay for talent. There's never been a situation where you haven't had to pay for talent. If you're a tech exec and you're running Snowflake or Salesforce or whatever it is, those are some of the most highest paid people are under your roof. So not new for tech, not a big deal. So kicking off our tier 2 sort of list of names that I think look interesting, and we want to buy these up a little bit of a different way, right? Not full positions necessarily. Buy up to half a position now, I'm saying, or the first half of this year. The caveat to that, I will say, if you get on a conference call, you listen to a report, I'm going to put ServiceNow out there as an example. They recently reported great numbers. They talked about seeing an acceleration in growth. So if a company's seeing an acceleration in growth, so that top line is now, they have a robust top line. They see that improving going forward. And if profitability is coming with it, all the better. But I feel like those are names you can probably buy a little more of, if that makes sense, right? But in general, these are the stocks we're looking at for this kind of half position weighting in the first half of this year. The money saving stocks, right? The stocks that really help businesses do what they do cheaper and more efficiently. And I'm calling it also the critical stocks. And you'll see what I mean by that. There's one group in particular that rings true for that. Excuse me. So the money saving stocks, Salesforce obviously is up there. Stock doesn't act that great. So wouldn't want a full position in that if it was me right now. And we don't have a full position. We do own it, but not a ton of it. ServiceNow, we just talked about that. That for me looks a lot more compelling. I like how they're structured. I like the posturing of the CEO. I like how that stock acts a lot better. I think it's trading above its 200-day moving average now. NVIDIA, I'm just going to call it Jensen Huang, kind of like Lisa Su. Jensen Huang, true visionary of our time, amazing CEO. I think you always want to have some NVIDIA stock. So when their quarter reports next week, that's a call I'm definitely going to be paying attention to see if I want to increase my weighting in that stock now. And cybersecurity, that's on the critical side, right? There's not a firm out there that doesn't need cutting edge cybersecurity. Palo Alto is the cheapest one. It actually has a PE, has earnings out there. The other ones are a little pre-profitability, but amazing companies, amazing growth. CrowdStrike, Okta, Zscaler. Excuse me, I'm having a tough time with my cold. So another group, same category. We want to get up to about half a position in these. Again, if you're looking to have like a 4% weighting in this, maybe up to 2% in the first half of this year. Stocks that are close to being elite growth companies, valuation is probably still perceived as expensive in terms of a PE, if they even have a PE, or it's relatively inexpensive on a price to sales multiple, but not profitable yet. Those would be, sorry, Amazon, Uber, Upstart, Generac, Snowflake, The Trade Desk. All of these elite growth companies. Some of them feel like they're running away on you right now, like Trade Desk and Snowflake in particular. I wouldn't feel like you have to chase in this environment. I like to buy on down days. So let that be the rule, I think, for tech. And those companies have not reported yet, but they probably did get a little overcooked to the downside, especially Trade Desk. So what if, moving on, what if growth does slow? This is kind of like sounds like it might be a bad thing or a headwind for tech. I don't think it is. You get macro growth that slows. That's a huge win for secular growth technology, right? So let's say the macro situation slows down like we talked about before as a possibility. As the Fed's, that's what they're trying to implement here. So let's say the Fed only raises rates 4 times because things are slowing and inflation is moderating. So they're going to get, you're going to get March and you're going to get another one in the meeting after that. And then maybe growth ticks down a bit. Maybe they skip a meeting and they go again. I don't know how this potentially can happen necessarily, but the point is, if growth does slow to the point where it affects inflation and you get moderation, maybe they go 4 times, maybe 5 times, maybe not 6 times. But as growth slows, you're going to start to see a migration. And as the market gets used to this higher rate environment, which again, I think it already is, we've seen that, you're going to see a migration back into secular growth stocks. And it's going to happen, as you guys know, it's going to happen before the writing's on the wall. No one's going to wave the green flag. That's why I think you need to start accumulating slowly in pieces over time. This is my tier 3 stocks. Most, I'll call them most speculative. So most of their revenues and profitabilities are in the out years, right? But still amazing companies. Bill.com just reported, Roblox, you guys know Roblox, UiPath, artificial intelligence, robotics company, amazing company. Unity Software and Matterport I have next to each other. Those are the big metaverse names, right? Unity Software, a lot of other really interesting applications from their software besides just metaverse type things. So that's to me, that's a must own. You got to decide when and how you're going to do it. Doma, Palantir, Intelia, and Beam. Intelia and Beam are both genetic engineering and sequencing companies. I think going to be huge in healthcare therapeutics going forward. And then Grab, as well as C Limited, are both Singapore companies that are into multiple businesses, whether it's rideshare, e-commerce, what have you. Grab is a recent SPAC. I think it does look interesting. But again, you see it right there. You want to buy these in 30, maybe 50 BIP increments at a time to get to a full position. So if you're looking to have this thing at 4%, you're buying this thing potentially 8 times, right? I think, just slow and steady is going to do it. When people are puking out the stocks, you want to be buying a little bit more of some of your favorites. All right, closing remarks. Sorry about the cold. So advisors, you've got positioning portfolios. You've got a roadmap to incorporate more growth in the portfolio as 22 moves ahead. I think it's important. I think if this is any part of what you do as a portfolio manager for your firm, I think that this is the time. In the meantime, you likely have a nice mix of interest rate sensitive, value-based stocks, funds, if you're more on the passive mutual fund side. I think that makes all the sense in the world right now, right? Banks and materials, that's doing the best in my portfolio year to date as well. Thoughts on what you might tell your clients: that you do have a thoughtful and deliberate process in place to incorporate growth in the portfolio. In the meantime, again, you have these interest rate sensitive stocks that are big beneficiaries and are doing well in the current environment. So nobody needs to, walk the plank. Investors, you got some shopping ideas, hopefully, maybe some names you can add to your current shopping list. And one thing I should say, the list of stocks here was nowhere near all inclusive. I could have probably added Twilio to the names that, check the box on a solid execution, solid report, great company. Looks interesting here as well. Keep an eye on Q4 earnings reports. So I think that's so important. For a name where you just can't help yourself, you have to own it. NVIDIA, whether it's ServiceNow, Unity Software, maybe get that initial position if you're totally uninvolved in front of the print. But I think a lot of you want to wait and see how that stock reacts, what the posturing is from the CEO coming out of that print, because this earnings season has been wild in terms of huge moves, and you've seen them on both sides. Be patient. Things aren't going to run away from you. You're going to get chances. Again, even the stocks that do execute well, like the Googles of the world, big gap up, right? And then it just bled lower day after day after day. That's when you can buy these things. The big watch out, I have watch outs there. The big watch out, obviously, if inflation keeps on roaring and the Fed has to get more aggressive and all that nonsense, then, it's not like game over, but things have to be a little bit more tempered in terms of how much tech you're putting on in the first half of this year. I do like where we're at. I do think this is a good way to think about things. So in case you're new to Grinnell Capital, we do endeavor to help financial advisors build successful practices through our proprietary investment models, as well as timely market insights through consulting. And we have exclusive events that we offer. Events coming up, more events that aren't exclusive right now, Smoothies and Stocks. Every Wednesday, we do a new update there. Macro reviews, we're going to do another one on March 17th. We haven't quite decided exactly what we're going to do there, but it'll be something timely, I promise. And we're send suggestions. Oh yeah, and then send suggestions too. That'd be great. And then peer-to-peer dinners. We got our first one coming up in February 17th in Denver. Really looking forward to that. We might be doing one in Boise potentially on Feb 24th. We got to test the waters. If anybody here is from Boise, don't get offended. You didn't get an invite. We haven't sent them out yet. We're thinking about that one. Yeah. So comments, concerns, future topics, email me, frank@grinnellcapital.com. I want to thank you very much for tuning in. Look at that. Isn't that nice? We could all wish we were all like right there right now. It looks beautiful right there. Good luck this quarter. Good luck with earnings season. Be patient and go get them out there. Disclaimers.
Tell them about you don't trade for 72 hours.
Oh, then stocks that we've listed, we won't trade for 72 hours. Since we're leaving on a little trip, that won't be a problem. All right, guys. Thanks. Enjoy the rest of your week. Have a good weekend.